I'm going to talk a little bit about bad signal bars. But first of all, in order to understand what a bad signal bar is, we have to know what a good signal bar is. And that's kind of the fundamentals of price action. And you can read about it in Al's books, or you can watch videos in the video course. It's one of the first few videos. Al talks a lot about signal bars. He gets into it. And the basics are that bears want to sell below bear bars, and bulls want to buy above bull bars. And the strongest types of signal bars are reversal bars. So for example, on today's chart, a good signal bar for the bulls, a good example is bar 34, 46, 49. And then for the bears, good signal bar 5, good signal bar 9. So if those are good signal bars, what's a bad signal bar? Well, it's the exact opposite. So the worst types of signal bars for those traders, it's the opposite. The bulls, it's a bad signal bar if you buy above bar 9. For the bears, bad signal bar selling below bar 46. And then there's everything in between. So there's kind of a spectrum. And the more the bar is closing above its midpoint, near its high, and then preferably with a tail, the better it is for the bulls. So bar 14, it's a bull reversal bar. There's a bull body, but it's basically a doji. It has a very small body, so it could be better. That's why a bar like 34 is stronger than 16. This is strictly signal bars we're talking about, though. This is not even context dependent. And then the opposite for the bears. So the bears, bad signal bar to sell below a bar like 49. A good signal bar, a better signal bar is 48. It's a bear reversal bar, even though it's basically a doji, small signal bar, or small body on the bar, but closing below its midpoint, so better for the bears than selling below a bar like 49. But again, that's always context dependent. So I wanted to talk about two quick examples of yesterday where bad signal bars led to breakouts, and the bad signal bar, the signal, so in this case for the bulls, the high of the signal bar becomes support, and then for the bear case, the low of the bar becomes resistance. So what I'm talking about, for example, if you look at bar 6 on this day, and we'll go back as if it's in real time. Okay, we see maybe 2 or 3 legs up to the moving average. Bar 1, pause, bar 3, pull back, and then up to bar 5. 3 pushes up, and then a bear bar at the moving average. Some bears, they'll sell below this bar. For the bulls, probably not ideal to buy above it. It's a bear bar closing below its midpoint. Trading range bar, probably sellers above. And therefore, you probably have bears selling above bar 6 and bulls hesitant to buy above bar 6. It's not an ideal bar to buy above on a stop order. And then we got bar 7. And 7 was a surprise bar. It's a big bar. It's a breakout bar, closing far above the prior bar's high. So what just happened? Bar 7 trapped traders. So you have bears who sold above bar 6. So if you imagine you're a bear. Let me see if I can draw this quickly. You're a limit order bear, and you sell above bar 6. And your argument is 3 pushes up to the moving average. You look to the left, big up, big down. We're probably in a trading range. yeah, we might be in the middle. We could turn down here. If we do go higher, I can scale in higher. And, this part is kind of irrelevant for the conversation, but let's just say you scale in somewhere higher, like at the top of the trading range somewhere, and you're using a wide stop, some kind of measured move up. So here's your stop. No one's actually going to risk that much, but just for the sake of the argument. So you sell above bar 6. Bar 7 is your entry bar. You look at bar 7 and you say, darn, that's a really terrible entry bar. It went really far against me. It closed above my entry price. So maybe you scaled in during 7. Maybe you'll scale in on the next bar or wait to see what happens. But if you're a bear and you sold above bar 6, you're clearly disappointed with bar 7. So we'll make a horizontal line, the theoretical entry price. You're short here. The market rallies and closes here. So what are you going to do if the market retests the high of bar 6? If you're lucky, if it comes back down and tests it, you're going to get the heck out of your short. The market's probably going to get a second leg up after bar 7, and this is the reason. It's trapped traders. Bears sold above, they're trapped into a bad short. There's now support at this price level. At the same time, remember I said I had to pause there for a couple of minutes, so I hope I'm picking up where I left off. I think I talked about the bear case, and now I'm talking about the bull case, where I know I mentioned the bulls see 3 pushes up. We're all below the moving average, all the bars below the moving average. Bar 6 is a bear trading range bar. You can call it a bear reversal bar. We went up, we closed below the midpoint, but there's a tail below. So probably a lot of trading range price action on the bar. You go to a smaller time frame, this bar probably went up and down, up and down. It's a trading range, and you know that traders in a trading range buy low and sell high, so probably buyers below, sellers above. And there's less of an incentive in this context for the bulls to buy above bar 6. So the bulls are not buying, the bears are selling, and then we get bar 7. So now what happened to the bulls? The bulls see the distance the market went. We broke out a fair distance, and it's close to a 10-point breakout, maybe 7 or 8 points. All of a sudden, there's this breakout that the bulls missed, and they're not going to buy when the market's at the top of a trading range. They're going to buy on the retest of the bad signal bar, maybe the breakout point, the bar 5 high. So now you have bears who are looking to buy back shorts at the bar 6 high. You have bulls who are trying to buy to initiate new longs at the bar 6 high. You have bulls who bought lower, who rode that breakout. They're looking to add on a breakout pullback. And what does that lead to? Leads to an imbalance. So now we have support at the bar 6 high. Bar 8 comes back down. You can see we retest the bar 6 high. We might have broken out 1 tick below it. So anybody who had an order to buy or sell at the bar 6 high had their order executed. The market went at least 1 tick below it. What's the expectation from here? Big bull breakout, sideways for a bar. So breakout, pause, expectation, another breakout to the upside. Bar 7 likely strong enough for a second leg. We know there's support at the bar 6 high. So bears not too eager to sell here, but they'll sell higher, and the bulls are willing to buy here, look to take profits higher. And then we got another leg up, and then what happened? Top of the trading range, we get a reversal down. The other example I wanted to talk about on this day was bar 51, I believe. So look at bar 51. Same exact thing, but now we're going to talk about a bear breakout. And it's actually not the greatest example. Bar 7 was actually a better example, but this is going to do for this video. Bar 51. It's a bull reversal bar closing on its high. So that's just about the worst signal bar the bears can get. And again, I don't want to get into the context discussion. That's an entire different video. I would have to make a video on that. But the point is, context does make a difference, and context is always more important than the signal bar. So yes, you can argue we had a rally, and then we're pulling back, maybe 2 legs up, testing this possible climactic late leg. We might be late in a trend. This was an exhaustion gap. We closed the gap. 2 legs up, double top with bar 42.51. I see the argument selling below it. But if you just play along with me on this example, bar 51 is a bad stop order signal bar for the bears. So the bears, they don't really want to sell. The bulls, they'll buy below the bar. Then we get bar 52. If a bull bought below 51, they're disappointed with their entry bar. Even though it closed above their entry price, you got a bear trend bar for your entry bar. And if you're buying below a bar, you want a bar like bar 4. You think about the bulls who bought below bar 3. Actually, that's a great example I could go back to. I'll talk about that one after this one, and then I'll go into the review. But right here, so 51 bulls buy below the bar. Disappointing entry bar. They'll probably exit, look to buy lower. The bears see that the bulls are disappointed with their entry bar, so they might sell. And then we get a downside breakout, crossing the moving average, strong enough for a second leg down. A bull had to be really quick to avoid a loss on this trade. We don't know how quickly bar 53 sold off, but we do know that there's no tail above the bar. Very little overlap. Probably 80% of bar 53 is not overlapping the prior bar. So it's a pretty decent breakout right there. So what happened to the bulls? If a bull bought below 51, arguing it's a micro channel, 4 bars up, 45 to 51, I'll buy below the bar. Worst case, use a wide stop, scale and lower. And 4 bar micro channel, bull, reversal bar, probably buyers below for a second leg. It's a reasonable trade. And then they get trapped on 52.53. Now the bulls are disappointed. They'll use any rally they can get. Just ask yourself, what would you do if you bought below bar 51 and you got 52.53? If you're still long at this point, regardless of if you scale in, you look to the left for a breakout point, look for a bear bar, whatever it is, maybe you scale in a little bit lower. But even if you don't scale in, if you're long and you get bar 53, the logical thing to do, this is probably getting a second leg down. Traders are trapped and sufficiently disappointed. There's probably resistance at the bar 51 low at this point. And then what happened to the bears? 51, yeah, possible double top, but bad signal bar, maybe wait for a better signal bar. This is why this example isn't quite as good. The bears actually got a reasonable signal bar 52, and traders sold below it. But you also have bears who did not sell because 51 was the signal bar, 52 was the entry bar, did not close below. So bears, this wasn't the cleanest sell setup. You also have maybe 20 bars above the moving average. It's a moving average gap bar. There's probably buyers here for a couple of reasons. However, on a retest, you have trap traders above. Bulls are looking to sell out of their losing long positions around the 51 low. Bears are trapped out of a winning short position. They're looking to sell around the 51 low to initiate new shorts. What's the result? 54 vacuum test of resistance, and then immediately we got a second leg down. And you consider the context, that's probably a scalp, probably buyers below 53, and probably going to go more sideways. Now, one more good example on this chart that I just saw. Bar 3 is actually a great example of what I'm talking about. Bar 3. So you think about what Al talks about with the bare minimum. There's a minimum for everything in trading. Like, in order for your trader's equation to be positive, you have to go for at least 1 times your actual risk. And sometimes your actual risk is really small. And so taking profits at your 1 times actual risk, it's really not optimal. It's profitable and it might work, but a lot of times it might not be the thing you want to do. That's just the minimum. He talks about it in this way. Do you want to strive to get D's in school? Of course not. It might be the minimum and you'll pass the class, but nobody wants to strive for D's. And the reason I'm saying all of that is because of bar 3. Bar 3 is a sell reversal bar. It's closing below its midpoint, but it's basically a doji, and it actually has a bull body. It's a bull close. So bar 3, it's a sell reversal bar, but it's not a bear reversal bar. So for the bears, it's a reversal bar. There's a big tail above it, and sure, you can sell below it. And again, my mind always goes to context, and the context really doesn't support the stop order sell here either, below 3. But if we just focus on the bar 3 signal bar alone, we can say, okay, the bears have a signal bar. It closed below its midpoint. It's a gap down, bar 81 plus the gap down, leg 1, probably going to get a second leg down. And now we have a low 1 short below bar 3. So you have traders selling below bar 3 on stops, and then you have bulls. Maybe they'll look to buy lower, maybe on a test of bar 1. And then what happens, obviously, any trader who sold below 3 got trapped into a losing short position. However, the market's in a trading range. So if you don't panic, you see 3 pushes up, testing the top of the range, good reversal bar. Maybe you sell below bar 3, sell more below bar 11. See if you can get out at break even. And just one more thing between that, before you get out at break even, maybe you can exit break even on the entire trade. So what I mean by that, at first I was talking about exiting break even at your original entry price. However, if you scale in, this is how you increase your probability. You sell below 3, you sell more below a strong bear bar, 11, you exit at the midpoint of the 2 entries. What happened on bar 14? We tested that average price, and then traders bought. But then you had a micro channel, and this is a sort of a bare minimum bull signal bar, probably more sellers above, micro channel, strong enough breakout for a second leg. This was a parabolic wedge. You're expecting 10 bars and 2 legs. There's your second leg, and look where we tested. The bar 3 low. Stop order bears trapped, and then they get the retest, and then you can see that price became support, and we had to go much higher before we found sellers. So I hope that was helpful.